My dear students, welcome back to our channel. In this video, I will be explaining the BCom first semester subject Financial Accounting 1 as prescribed by Osmania University and other universities of Telangana. We will go through the important questions and answers one by one. Let's begin with a quick revision. Unit 2 first important short question is: explain the debit note and credit note. Debit note. A debit note is a document sent by a buyer to the seller to request a reduction in the amount payable. It is used when goods are returned due to defects, excess supply, or damage. Think of it as the buyer saying, "I owe you less money because I'm returning some goods." Example: Ravi buys 100 chairs from ABC traders at 500 rupees each. 10 chairs are damaged. Ravi sends a debit note for 5,000 rupees, 10 times 500, to ABC traders. Credit note. A credit note is sent by the seller to the buyer in response to a debit note. It reduces the buyer's liability in the seller's books. Basically, the seller acknowledges, "You don't need to pay this part." Example: ABC Traders issues a credit note of 5,000 rupees to Ravi for the 10 damaged chairs. Tip to remember: debit note buyer initiates. Credit note seller confirms. Next important short question is: to distinguish between cash discount and trade discount. Trade discount. Given by the seller to the buyer at the time of purchase. It is a reduction on the list price of goods. Mainly offered to encourage bulk purchases or loyal customers. Not recorded in the books of accounts, only the net amount is recorded. Example: a shopkeeper buys goods worth 10,000 rupees from a wholesaler who offers 10% trade discount. The shopkeeper pays 9,000 rupees, 10,000 1,000 and records 9,000 rupees in the books. Cash discount. Given to the buyer for prompt payment or early settlement of the invoice. Recorded in the books of accounts. Encourages quick cash collection. Example: if the shopkeeper pays within 10 days, the wholesaler offers 2% cash discount on 9,000 rupees 180 rupees discount. The shopkeeper pays 8,820 rupees. Tip to remember: trade discount is equal to price reduction at purchase. Cash discount is equal to discount for quick payment. Next important short question is: 3. Explain journal proper. Journal proper. The journal proper is a book of original entry where we record transactions that do not fit into any other subsidiary book. Think of it as the catch-all journal for unusual or miscellaneous transactions. Key points. It records transactions like purchase or sale of fixed assets, adjustments, opening entries, or rectification of errors. Entries are made in chronological order. Every entry has a debit and a credit side, following double entry rules. Example: 1. Purchased office furniture for 10,000 rupees from Ramesh on credit. Furniture ACDR 10,000. Ramesh ACCR 10,000. 2. Paid 500 rupees as insurance premium. Insurance ACDR 500. Cash bank ACCR 500. Tip to remember: subsidiary books handle routine transactions. Journal proper is equal to everything else. Next important short question is: 4. Drew impressed from head cashier. I. Opening balance 300 rupees, paid for stamps Rs.25, paid for cleaners expenses Rs.20, paid for cartage Rs.25, paid for office refreshment 50 rupees, prepare petty cash book. Given: opening balance, impressed, is equal to 300 rupees. Payments. Stamps is equal to 25 rupees. Cleaners expenses is equal to 20 rupees. Cartage is equal to 25 rupees. Office refreshment is equal to 50 rupees. Step 1. Understand imprest system. The petty cashier is given a fixed amount, 300 rupees. Payments are recorded in the petty cash book under different heads. At the end of the period, the petty cashier is reimbursed to restore the imprest. Step 2. Prepare petty cash book. Date particulars LF amount hours. To petty cash, opening balance 300. Stamps 25. Cleaners expenses 20. Cartage 25. Office refreshment 50. Total paid 120. Balance 180. Step 3. Calculate remaining balance. Total spent is equal to 25 plus 20 plus 25 plus 50 is equal to 120 rupees. Balance is equal to 300. 120 is equal to 180 rupees. Tip to remember. Column heads, date vertical bar particulars vertical bar L.F vertical bar amount. Always subtract total expenses from imprest to get closing balance. Imprest system is equal to fixed cash, replenish as used. Next important short question is 5. What are the types of errors? Types of accounting errors. 1. Errors of omission. When a transaction is completely left out from the books. Example, bought goods worth 5,000 rupees but didn't record it anywhere. 2. Errors of commission. When a transaction is recorded incorrectly in the books. Example, paid 2,000 rupees to Ravi but posted it to Ramu's account. 3. Errors of principle. When accounting principles are not followed. Example, treating capital expenditure as revenue expenditure. 4. Compensating errors. 2 errors cancel each other out. Example, overstating sales by 1,000 rupees but overstating purchases by 1,000 rupees. 5. Errors of duplication. When a transaction is recorded twice. Example, recording a cash sale of 500 rupees 2 times. Tip to remember. Omission is equal to missing, commission is equal to wrong account, principal is equal to wrong method, compensating is equal to cancel out, duplication is equal to repeated. Next Unit 2. Long questions. First important long question is: what are subsidiary books? Explain advantages and disadvantages of subsidiary books. Subsidiary books. Meaning. Subsidiary books are special books of accounts used to record similar types of transactions in detail instead of writing them all in the general journal. They are also called books of original entry. The main purpose is to simplify bookkeeping and make it easier to manage a large number of transactions. Example. Purchases book records all credit purchases of goods. Sales book records all credit sales of goods. Cash book records all cash and bank transactions. Purchase returns book sales returns book records returned goods. Instead of entering every sale or purchase individually in the journal, you use subsidiary books, then post totals to the ledger. Advantages of subsidiary books. 1. Saves time. Transactions are grouped, reducing repetitive recording. 2. Reduces errors. Similar transactions in one place make it easier to check mistakes. 3. Provides complete details. Shows details like date, party name, invoice number clearly. 4. Easy posting to ledger. Only totals are posted, saving effort. 5. Better organization. Helps in quickly finding transactions, like all credit sales or purchases. Example. If you buy goods from 50 different suppliers in a month, Instead of recording 50 entries in the journal, you record them all in the purchases book and post the total ones in the ledger. Disadvantages of subsidiary books. 1. Extra work for small businesses. Small firms with few transactions may not need separate books. 2. Possibility of overlooked entries. If a transaction doesn't fit any subsidiary book, it may be missed. 3. Requires knowledge. Users must know which transaction goes to which book. 4. Dependence on ledger. Totals from subsidiary books must be correctly posted to the ledger, else errors affect accounts. Tip to remember. Subsidiary books is equal to specialized journals for efficiency. Advantages is equal to saves time, reduces errors, organized. Disadvantages is equal to extra work for small firms, requires careful posting. This method makes bookkeeping systematic, neat, and easy to handle, especially for traders and businesses with many transactions. Next important long question is: 2. What do you mean by subsidiary books? Explain different types of subsidiary books with their respective formats. Subsidiary books. Meaning: subsidiary books are special books of accounts where similar types of transactions are recorded first before posting to the ledger. They help in saving time, reducing errors, and organizing accounts. Every transaction need not be entered individually in the journal, instead, it is recorded in the relevant subsidiary book. Types of subsidiary books with formats. 1. Purchases book. Records all credit purchases of goods. Format. Date supplier invoice no. Details of goods LF amount Rs. Example: bought 10 chairs from Ravi on credit for 5,000 rupees, enter here. 2. Sales book. Records all credit sales of goods. Format. Date customer invoice no. Details of goods LF. Amount Rs. Example: sold 5 tables to Rajesh on credit for 7,000 rupees, enter here. 3. Purchase returns book. Records goods returned to suppliers. Format. Date supplier credit note no. Details LF. Amount Rs. Example: returned to damaged chairs to Ravi, enter here. 4. Sales returns book. Records goods returned by customers. Format. Date customer debit note no. Details LF. Amount Rs. Example: customer returned 1 table, enter here. 5. Cash book. Records all cash and bank transactions. Can be single column only cash, double column cash plus bank, 3 column cash plus bank plus discount. Format: 3 column cash book. Date particulars LF discount cash bank. Example: paid rent 500 rupees by cash, enter in cash column. 6. Journal proper. Records transactions not entered in other subsidiary books. Example: purchase of furniture, adjustment entries. Format. Date particulars LF. Debit Rs, credit Rs. Example: purchased office desk on credit, journal proper. Tip to remember. Purchases sales book is equal to credit transactions. Returns books is equal to returned goods. Cash book is equal to cash and bank. Journal proper is equal to everything else. This system makes bookkeeping simple, organized, and less error-prone, especially when many transactions occur daily. Next important long question is: 3. Prepare relevant subsidiary books from the following 2016 DEC. Step 1. Analyze the transactions. Credit sales, sold on credit sales book. 2nd December, sold to Ramana 2,800 rupees. 8th December, sold to Kishore 3,800 rupees. Cash sales, sold for cash book, cash column. 22nd December, sold to Madhva 1800 rupees. 31st December, sold to Ramana 500 rupees. Credit purchases, bought on credit purchases book. 6th December, purchased from Raghava 1800 rupees. 12th December, purchased from Rekha 7500 rupees. 18th December, purchased from Rajesh 5000 rupees less 2% trade discount is equal to 4900 rupees. Cash purchases, bought for cash book, cash column. 9th December, purchased from Manohar 2300 rupees. Purchase returns, returned goods to supplier purchase returns book. 25th December, returned to Rekha 50 rupees. Sales returns, customer returned goods sales returns book. 15th December, Ramana returned 150 rupees. 30th December, Kishore returned 100 rupees. Other purchases, non-trading items journal proper. 27th December, purchased furniture from Godrej & Co 4500 rupees. Step 2. Prepare the subsidiary books. Purchases book, credit purchases. Date supplier invoice no. Details LF amount Rs. 6th December Raghava, goods, 1800. 12th December Rekha, goods, 7500. 18th December Rajesh, goods, 4900. Sales book, credit sales. Date customer invoice no. Details LF amount Rs. 2nd December Ramana, goods, 2800. 8th December Kishore, goods, 3800. Purchase returns book. Date supplier credit note no. Details LF amount Rs. 25th December Rekha, returned goods 50. Sales returns book. Date customer debit note no. Details LF amount Rs. 15th December Ramana, returned goods 150. 30th December Kishore, returned goods 100. Cash book, cash transactions. Date particulars LF cash, Rs, bank, Rs, discount. 9th December Manohar, 2300 payment. 22nd December Madhva, 1800 received. 31st December Ramana, 500 received. Journal proper, other transactions. Date particulars LF debit, Rs, credit, Rs. 27th December furniture ACDR, 4500. To Godrej & Co, 4500. Step 3, tips to remember. 1. Credit transactions purchases sales book. 2. Cash transactions cash book. 3. Returns purchase sales returns book. 4. Non-trading items journal proper. 5. Always analyze first, then record in the correct book. Next important long question is 4. Prepare 3-column cash book of Mohan from the following particulars. Here's a step-by-step solution for preparing 3-column cash book of Mohan. Step 1. Understand the 3-column cash book. It has 3 main columns. 1. Cash column records cash transactions. 2. Bank column records bank transactions, checks, deposits, withdrawals. 3. Discount column separate columns for discount allowed, debit side, and discount received, credit side. Debit side, cash bank received, discount allowed. Credit side, cash bank paid, discount received. Step 2. Analyze transactions. Date particulars cash bank discount allowed discount received explanation. 1st April balance BD 300 minus 450 opening balance cash in hand 300 rupees bank overdraft 450 rupees. 2nd April purchased goods cash 30 Cr cash paid for goods. 2nd April cash sales 80 Dr. cash received from sales. 3rd April paid Krishna by check 260 Cr check payment to settle account. 4th April received from Dhawan to 35 Dr. 15 full settlement discount allowed 15 rupees. 5th April received check from Ali Bros 190 Dr. 10 debt 200 rupees discount received 10 rupees. 5th April cash deposited into bank 200 Cr transfer cash to bank. 6th April check of Ali Bros dishonored 2 Cr bank charges. 6th April paid rent by check 100 Cr bank payment. 7th April bank collected interest 150 Dr. bank received interest. Key Dr is equal to debit inflow, Cr is equal to credit outflow. Step 3. Prepare 3-column cash book. Date particulars LF cash, Dr. Cr bank, Dr. Cr discount allowed discount received. 1st April balance BD 300 minus 450. 2nd April cash sales 80. 2nd April purchased goods 30. 3rd April paid Krishna 260. 4th April received from Dhawan 235.15. 5th April received from Ali Bros 190.10. 5th April cash deposited into bank 200. 6th April bank charges 2. 6th April rent paid 100. 7th April bank interest 150. Step 4. Tips to remember. 1. Cash inflow debit cash column, cash outflow credit cash column. 2. Bank inflow debit bank column, bank outflow credit bank column. 3. Discount allowed debit, discount received credit. 4. Always analyze first, then enter in the correct column. Next important long question is 5. Rectify the following errors and find out the effect of the errors on net profit. Here's an easy to understand solution for rectifying errors and analyzing their effect on net profit step by step. Step 1. Understand the types of errors. Errors can be 1. Errors of omission, transaction not recorded. 2. Errors of commission, wrong posting account used. 3. Errors affecting profit, incorrectly recorded revenue expense. We will rectify using journal entries and note effect on net profit. Step 2. Rectification of each error. A. Purchase of 300 rupees from Raman passed through sales book. Error. Purchase recorded as sales overstated, purchases understated. Journal entry. Purchases ACDR 300. To sales AC 300. Effect. Net profit decreases, since sales were wrongly increased and purchase not recorded. B. Bill received from Ramu for 500 rupees passed through bills payable book. Error. Bill receivable recorded as payable assets understated, liabilities overstated. Journal entry. Bills receivable ACDR 500. To bills payable AC 500. Effect. No effect on net profit, only balance sheet affected. C. Prepaid rent 150 rupees not brought forward. Error. Expense understated, profit overstated. Journal entry. Prepaid rent ACDR 150. To rent AC 150. Effect. Net profit decreases by 150 rupees. D. 400 rupees paid to Mehta be debited to Mehta N. Error. Wrong personal account liability misstated. Journal entry. Mehta B ACDR 400. To Mehta N AC 400. Effect. No effect on net profit, only balance sheet. E. Received 300 rupees from Ajit, posted to credit of Amrit. Error, cash receivable misposted asset misstated. Journal entry. Cash ACDR 300. To Ajit AC 300. Effect, no effect on net profit. F. Transistor sold to Karan for 750 rupees passed through sales book twice. Error, sales overstated, net profit overstated. Journal entry. Sales ACDR 750. To Karan AC 750. Effect, net profit decreases by 750 rupees. Step 3. Key tips to remember. 1. Check whether error affects profit or only balance sheet. 2. Journal entry always reverses wrong posting first, then corrects it. 3. Errors affecting sales or expenses impact profit. Errors in asset liability accounts no effect on profit.